Hello and welcome to this lecture on financial concepts and analysis. Financial models, the time value of money principle states that money earned today is worth more than money earned in the future. In other words, $10 in your hand today is worth more than the promise of $10 in your hand in 3 years. Even if you know the promise is going to hold true, even if it's guaranteed, $10 today is worth more than $10 in 3 years. Now, there's a couple reasons for that. First of all, inflation makes future dollars worth less in terms of buying power than today's money. In addition to that, money you have today for 3 years, you can invest it and presumably, hopefully, make money on the money you have today through your investments. That'll be a positive investment. So what that means is money today is worth more than money in the future. That's the time value of money. So that brings up some interesting ideas, some financial ideas. One is the payback period. So the payback period is the estimate of the time necessary to recoup the costs of an investment, such as investing in a new project if you were a project manager. It determines how long it takes for the project to reach the break-even point. A lower payback period is better. It is financially beneficial to have faster payback. So you want your payback period to be as low as possible. Now, payback period can be calculated very simply if you have fixed costs and fixed savings. It's just the investments divided by the one-time upfront investment divided by how much money you save annually each year. So in this slide, I show two examples. Machine A costs $15,000 and reduce operating costs by $5,000 a year. That's the annual savings, $5,000 a year. Machine B costs $12,000, so it's a smaller one-time upfront investment. But the annual cash savings is also smaller. It's only $3,500 a year, every year ongoing. So which one has the better payback period? Well, I can calculate this simple payback period by doing investment divided by the annual savings, and I get 15,000 divided by 5,000. That's 3. The units are years, so I get 3 years for that. And the B example, it's 12,000 one-time cost divided by 3,500 annual savings, and that's 3.42, blah blah blah, but 3.42 years. So A has a faster payback period, and therefore it's the better option of the two. It's a better investment to spend $15,000 up front and save $5,000 a year than it is to spend $12,000 up front and save $3,500 a year. Now, payback periods aren't always that clean. You might have a fixed one-time expense, but the revenue might not be a consistent $5,000 a year. So I don't want to get into, this is not a finance class, we don't want to get into the details of this, but you can see these two examples. This is from our book, where we have the first year we're spending money, the first year, $500,000, $500,000. But in year 2, year 3, and year 4, or years 1, 2, and 3, after a year, at the end we've saved $50,000. The cash flow has been in the positive. We've earned $50,000 because of our investment in this project, this activity. In year 2, it's $150,000. Year 3, it's $350,000. Year 4, it's $600,000. In year 5, it's going the other direction, but still $500,000. So what's the payback for this? It can be calculated if you just look at our cumulative cash flow. We started off out of pocket $500,000, and then at the end of that first year we made $50,000, so we were out of pocket only $450,000 at that point, and then $150,000 the next year, out of pocket only $300,000. And during that third year it went positive. We ended up making money in that third year. Now, it still doesn't tell us exactly when that payback is, and we can plug that into our calculators or our spreadsheets using the payback period, and it'll calculate to be 2.857 for us. And Project B shows that example as well. I can eyeball just by doing the $500,000 up front and then knocking that debt out with my income each year. I can see that sometime after the fourth year and during the fifth year, that goes positive. But the calculations for doing those are beyond the scope of what we're doing here. What we're talking about here is just there is a payback period that we can figure at which point is a break even for the investment. And if it's a simple payback, like we had on this previous slide, a simple payback is easy to calculate. And if I gave you anything on a quiz, it would be a simple payback like this, the one-time investment divided by the annual savings. But you can do complex payback periods as well. Okay, another financial term, financial model we want to be aware of, based on the fact that future dollars are different than today's dollars, is the idea of net present value. Net present value calculates the change in the firm's value if the project is undertaken, the benefit. Now, a positive net present value means the firm is worth more money. It's a good thing. If you invest, not all investments are good things, but a positive net present value is a good thing. And we're not going to whip out our calculators here, but just realize that a net present value involves these variables that we can look at. The I value there, the formula is net present value equals I0 plus the sum of some other variables, and each of those items are described here. So it's the I, which is the initial cash investment, plus the year-over-year sum of the cash flow for that period divided by the rate and the inflation during the period. So inflation, you can see, is one of the factors in net present value, and so is the rate of return, the required rate of return. In net present value, you get to make a calculation that says this is only worth doing if we're going to, we're going to assume we're going to make 8% or 5% on this investment as part of our calculation to see if this is going to work. Now, you want high net present values because higher values are better in this case. It means we're worth more right now today equivalently by investing in this activity. So here's a question that they propose in the book, I believe. Should you invest $60,000 on a project that will return $15,000 per year for 5 years? You have a minimum return of 8% that's required as your company's, as your organization's financial plan to do any kind of an investment, and you expect inflation to be 3% a year over the next 5 years. So the question is, should you spend $60,000 to get 5 years of 15, which is, do the math real quick, $75,000? Seems like a good trade, right? $60,000, and in return I'll get $75,000. If I could make that trade right now and get my $75,000 right now, of course I would do it. But I'm getting my $75,000 spread out over 5 years. Is it still a good deal? Will it return me my 8% profit on my my initial investment, taking into account 3% inflation? So we can do this by doing getting a discount value factor calculated using the net present value formulas, and we can apply that discount factor for each of the years. So my $60,000, that's today dollars, there's no discount on that. I'll get $15,000 at the end of year 1, but that's not the equivalent of $15,000 in my pocket because of inflation. So it gets knocked down a bit, and because of what I could have gotten with that $15,000 or that $60,000 if I had invested those. So I'm getting back the equivalent of $13,513.51 according to that formula. Same thing with year 2, 3, 4, and 5. Even though I'm getting $15,000 in year 2, year 3, year 4, year 5, the today dollars, the net present value of those dollars, is only $12,000 in terms of buying power, and the equivalent of that, $10,000, $9,000, $8,000. So if I add up all of my investments there, the $60,000 that I spend plus all the money that I take in over those 5 years, which isn't a true $15,000 each year, it's net present value, $13,000, $12,000, $10,000, $9,000, $8,000. I end up in the hole. I end up negative $4,000. So my net present value on this deal, this proposed deal, is negative. Therefore, it's not a good deal it will not give me a 8% return on investment. I need to find another place to invest my money to be a good financial steward there. What about internal rate of return? It's another one of our financial terms, financial models based on a change of $1 over time. The initial rate of return, this is looking at it in a slightly different level. We're saying, well, what's the rate that'll give me the desired financial return? And we can see some of our variables here. The ACF is the annual after-tax cash flow for a given time period. The initial cash outlay, what we're spending out today, right? $50,000 I'm investing or whatever, and the projected life of the project. N is years or time. You can kind of see on the little summation right here that that's a N equals 1 up to T, where T is the number of years, and they use T as a little variable for those things. And IRR is the project's internal rate of return. Internal rate of returns, higher is better. The more I'm getting a return on my investment, the better it is. And again, here's another example, and we don't have to do the math on this, but just understand that internal rate of return, a higher return of IRR is a good thing. We're getting more value for our money, and we can have some hypotheticals. We can say, here's a project, we're going to invest $40,000, and with the expectation of generating $14,000 for the next 4 years, our goal is to have a rate of return of 17%. Will this project meet that goal? And we can plug the values in. We get our discount values based on our IRR rates. This one, and there's a little different there. The book talks about if you've got a calculator or a spreadsheet that'll do the calculation for you, it'll estimate that. If you don't, you have to use a fixed value and plug it in with a fixed value and then figure out if it's higher or lower. These calculations are at 15%, and notice at 15% my net present value is negative. I'm not breaking even at 15%, so I'm certainly not going to meet our desired 17% requirement. And I could have plugged 17 in there, and the net present value would have been even more negative because I'd be even further from reaching that goal of 17%. So this is not a good investment as we look at it. Remember, we're talking about having multiple scarce resources, multiple projects to choose from. How do we make these choices? What we're looking at now are the financial issues. Previously, we looked at various different tools for comparing projects to another and making decisions. This last one, this fourth and last financial model that we're going to look at is even a little more high-level conceptual. It's an options model. The idea here is that some projects, NPR and IR, net present value and internal rate of return, some projects, those don't work very well. Specifically, projects where you have a real possibility of not recovering your investment. Things that have very high capital costs, like building buildings. I think they use the example of an oil refinery or some kind of a large expense like that you're not necessarily going to get your money out of. Even building a house on speculation might have that, might be something more familiar with somebody here in Bowling Green, Kentucky, or South Central Kentucky as a speculation. And sometimes you don't. I mean, sometimes you don't get not only do you not make a profit based on your expected rate of return, you don't even cover your cost. I mean, there's a real loss as opposed to a potential loss. So some projects, when you start them, makes a difference. The marketplace and buying a house, building a house, for example, it might be that right now is not a great time, or 6 months from now is not a great time to sell a house. But if you waited 2 years and then went through that same project, the market 2 years down the road might be much, much better. And sometimes you just don't have all the information that you need. If you can delay a project, you can sometimes get more information about the marketplace, about what competitors are doing, about some prices might become fixed that are currently unknown. So those things can allow you to think about a project from various options of delaying or doing it different. And this is, again, this is very wordy, and I'm not going to ask you to reproduce these numbers. But just realize that in this option model, the example they're giving us has a plan of doing an investment for a chemical plant, is what it was. And the goal is to spend, $5 million and get a 10% return on investment. And the cash flow is hopefully going to be $1 million a year. That's great. The thing is, there's a probability, a 40% probability that you're not going to get that. Only a 40% probability you get the $1 million, and there's a 60% probability because of things outside your control, adverse economic or political conditions, that you're only going to get $200,000 a year. So we can see the math here in the very middle of the screen, where we have our cash flow is 40% of the one possibility and a 60% likelihood of making only $200,000 a year. We can run the math and we can see that we can calculate our net present value. That's not a very good investment of $1 million, of $500 million. Now, if we could wait, one of the things we're talking about here is if we could wait a year, we might know some things. Our probabilities might change, becomes 50% and 40%, and the other numbers might change. And it's just the idea of on options, there are situations where you want to wait and consider your options over time as you get more information. Okay, project portfolio management. Portfolio management, and specifically project portfolio management, is the systematic process of selecting, supporting, and managing a firm's collection of projects. So again, there's more than one project going on in a firm at any time, but there's a limited number of projects because there's a limited number of resources. Those limited number of projects need to be managed so that they are constantly using those limited resources in an as maximized in a most ideal way possible. Portfolio management requires in fact, one of the keys on portfolio management is to remember that there's a common strategic purpose and limited resources. So we're always looking at making sure that everything's in the portfolio should be in the portfolio and it's serving its purpose. So that includes things like decision making. Remember, sometimes saying no is the best decision. Another way of thinking about this is this way. Every time you say yes to a project, you're saying no to every other possible project that would be using those same resources. So you don't just say, hey, this project is good. Sometimes good is the enemy of the best. And sometimes, and whenever you say yes, you're saying no to everything else you could have done with your time, your energy, your resources. And that goes not just for your project management, but it goes for your own personal time management and decision making as well. If you're a person who has trouble saying no to people, realize that by saying yes to whoever it is that happens to have your attention, you're saying no to all the other people in your life with your time and your energy and your efforts that don't happen to have your attention right then. Sorry, but we're talking about project management, not personal schedule management. So there's also the issue of prioritization, which again could apply to you personally, but we're looking at in the context of the portfolio of projects in your organization. Prioritization, it's always about going back to what is our mission statement as an organization. We know we can't do everything, but part of having a mission statement is that we can do something very, very well. If we can stay focused on what our mission is and everybody's pulling in the same direction, everybody's working on it, we can be very good at that. Review. Review is to make sure that the projects are and that they remain lined up with your prioritization, with your mission statement. So we don't want to just, because a project is in our portfolio, we don't just assume that it always lines up and it's going to be perfect, because things can change. Realignment, in fact, this is the change in a project portfolio when a new project is added. So anytime we add a new project, there's a sense of realignment, because sometimes we end up having projects that are doing similar goals and competing goals, and maybe it's better if we have a new project come in and we look at the realignment to take some other project out or to redirect resources in a different direction. Reprioritization of the firm's projects. If the company moves in a new strategic direction, then that absolutely causes you to revisit all of the projects in your portfolio that you're managing. Are these projects, which of these still line up with the new vision, which of these need to change slightly because of the new vision, which of these need to just be cut off and the resources reallocated based on the firm's new vision, new direction. Keys to successful project portfolio management, just real quick here. A research team recently studied 6 firms, all with multiple project development activities. They determined that successful portfolio management usually involves these 3 factors. Flexible structure and freedom of communication. So we want to avoid the restrictive layers of bureaucracy. There needs to be a free flow of information and knowledge and wisdom and best of practices and all of that without single bottlenecks of paperwork and micromanaging. And that's true not just in managing your portfolio, but probably in a number of things. I'm a big fan of good open communication and as much as possible. The second thing that the research team identified was the idea of these low-cost environmental scannings. In other words, you're not putting all your eggs in one basket. You're not going for the home run. You're not investing heavily in a high risk, high reward, but rather throwing a lot of seeds out, low cost seeds in a wide area, and trying to kind of scan the environment and find where the opportunities are. Every once in a while you can invest heavily in a all or nothing kind of a deal, and those things might hit sometimes and they miss as often as they hit. A lot of times if you can do this, this low cost seed scattering environmental, getting the temperature of the marketplace, you might find that there are some real opportunities that nobody else is currently in, and you can have the advantage of being a first mover in that area and working from that. So that's a better idea than building and investing in the big home run approach. And then the third thing that the study reported was time-paced transition. That is to say, having a schedule, giving yourself the long lead times that it's necessary to get projects done without them being rushed. Remember we talked about that pick any 2 out of 3. You can have time, you can have quality, you can have cost. Well, if you give yourself enough time, then you can earn the quality. You can get the quality and the cost that you want by not being rushed. And companies that are successful understand that. They give themselves long lead times that allows them to not have to compromise on quality and cost. And then here's our last slide. Problems in implementing portfolio management. And this is just short, but let's wrap this up. Conservative technical communities. The idea that there are people who want to maintain the status quo, especially technical people. When a system is running, when they have policies and procedures in place, technical people very often are going to kind of throw cold water on your excitement. They're going to say, well, I don't really know about that. Well, let's check with this. I'm not sure about new standards. And they can really slow things down. Anybody can do that. And anybody that's invested in the status quo can do that, but technical people in particular have the ability to just kind of shake their head and say, no, technically we can't do that. And the best laid plans of mice and men can get overthrown by a technical hurdle. Out of sync projects and portfolios, just losing focus. It's important to be focused while we have our mission statements, while we're all working together. We're much more effective as an organization when we're all pulling in the same direction. If we allow our portfolios to go in different directions, it's going to cause the same problems, just like we allow individuals to be going in all kinds of different directions. Unpromising projects that don't have bright futures, projects that may have seemed like a good idea 5 years ago, 10 years ago, 5 months ago, 5 days ago, but because something has changed, it doesn't seem like a good idea anymore. You don't want to have any of those in your portfolio. You don't want to be managing any projects that have that do not have bright futures. Every project should excite you. That it's one of the projects you're working on. And then scarce resources. And I said it before, I'll say it again. Realize that when you say yes, you're saying no. Every time you say yes to something, you're saying no to all the other possibilities that existed for that resource, for that time, for that energy. So in projects, remember in your portfolios and in your project selection that yes means no to other things. Don't think that saying yes makes you a super nice person, super friendly. Sometimes a no is what is needed.